Okay, so let's go over all the stuff we talked about in section 5. So we started talking about our market lens. And you could use any market lens, whatever works for you the best. Some people like to use Elliott Wave, some people like to use 5's. There's many ways to skin the cat in the market, but at MacroOps we like to use classical charting. And that's because we feel like it's very robust, it's been in use for a long time. Lots of traders have used it with success for many, many decades. And that's why we choose classical charting. It's also very simple as well. So the primary function, though, of classical charting is to identify inflection points, define our risk, and define targets. So we need to keep that in mind when we're using any type of market lens. It's not something that's going to be an oracle on where the market's going to go. It's a tool to use in the trading process. Then we segued into talking about the actual chart patterns that we look for. And I'm not going to go into the specifics here in this recap. They're pretty common patterns written about in a lot of places. But the way we look at them is slightly different in that we're thinking of the boundaries as zones, not exact price levels. So we don't take an absolute literal interpretation of, if price breaks the trend line by 1 cent. We're looking at the key is to look at a zone. In general, is price breaking out of the consolidation area. And then another interesting point from that lecture was that chart patterns are mostly working because of the volatility, compression, and expansion concept we talked about earlier. So when price gets congested, it forms a price pattern. And then this expansion out of that congestion is a lot of the edge that we get from identifying price patterns. And then finally, we talked about not falling prey to Rorschach analysis, which is injecting your bias into a chart is not something you want to do. So if you feel like, the S&P 500 should go up, you don't want to be going and looking at the chart and drawing patterns to justify your bias. You want to take a very objective view and an objective process so you get accurate trading signals out of the charts, not just what you want to happen. So then we segued into entries, and we talked about 3 primary entries off of patterns: breakouts, failed breakouts, and retraces. And we primarily use breakouts in our process, but all of these are definitely valid and you can use them. And then we emphasize waiting for candle closes to confirm moves. Otherwise, you're going to be caught into a lot of false noise. So we want to see the candle close outside of the boundary zone. And then on top of that, wide-bodied candles are even better. So if the candle shoots out and it has that really wide look like this with small wicks, where it's closing at the high of the day, or if it's a bearish candle closing at the low of the day, will help with the success rate on these things. And then we want to see the breakout candle expand the prior range of the congestion zone. That's another clear signal that price is going to continue. And then higher volume also helps. So keep these 4 things in mind when you're looking at the actual candle and the occurrence of the breakout. And then we talked about avoid buying breakouts from overextended moves. So if we have let's just say we have an ascending triangle, right, and price is consolidating back and forth here for a while, and then maybe gets to this bottom boundary line, then just all of a sudden rips to the upside. If the move is overextended in one way into the boundary line, we risk having a pullback because the move is overextended in the short term. So be careful when price really moves up quickly through the boundary line. Something to be aware of, because oftentimes you'll just get that retrace and it'll either knock you out of your original breakout trade. And then we talked about how horizontal boundaries are more reliable than diagonal boundaries. So horizontals are clear, they're an absolute price level, whereas diagonals have a time component to them. So a trend line always has a time component where the actual breakout level differs depending on what time price decides to go higher or lower. So that's why diagonals are just never as reliable. And also with diagonals, you're not ever buying the absolute high or low of the recent congestion, because if you buy a diagonal, there's always going to be a prior high or low that the price could eventually run into. So something to be aware of from that perspective. Then we went into pattern morphing, talking about the failure side of patterns, how they can and will fail, and the reasons for these. So unexpected news coming out from, say, Fed officials, or just natural disasters, something like that, will cause a pattern to fail. Higher time frame influence, so maybe we have really, really huge funds executing on a chart that have no regard for the price patterns. Sloppy identification, if you start thinking everything's a pattern, then those are going to start failing. The signal is going to be not as strong. And then adverse volatility regimes. So when we have contracting volatility and markets go from pretty lively to very, very quiet across the board, we'll see a decrease in the hit rate of patterns just because price will peak out of these consolidation patterns, then come back in because we're in a contracting volatility regime. Ideally, we want to see volatility slowly uptrending and expanding, and pattern trading will work better in those conditions. And then we talked about how the slope of the 200 DMA can be used to further filter your trade ideas. So only taking breakout trades in the direction of the 200 DMA will help you increase your hit rate if you're getting frustrated by taking a lot of stop outs. This is just something that we use sometimes if we want to further qualify our trades. And then we went and talked about time frames. So the higher time frames have less noise than the lower time frames. And we like the higher time frames because there's just less stress and use of emotional capital when you're trading higher time frames. The lower ones, there's a lot more staring at the screen that you need to do. There's a lot more micromanaging that you need to do. And so higher time frames just fits in better with how we like to design our week-to-week workflow. And that's primarily why we choose higher time frames, on top of the fact that the signals are more reliable. And then we went and discussed nested patterns. So that's an advanced topic, but it's looking for patterns within patterns that can serve as launching pads into large breakouts. And you get really tight risk with huge rewards when this occurs. So let's say we have some sort of falling wedge, and this is on the large time frame, and then we see a little mini pattern down here that breaks out. We might be able to enter on this mini pattern and get in earlier than if we were to wait for the actual breakout of the larger pattern. So that's how we can use nested patterns to get this tight risk with potential huge gains. And then after that, the next lecture was talking about market nuances. So each market exhibits different characteristics because of the players involved. So for example, bonds are never going to trade exactly like oil, and gold's never going to trade exactly like S&P 500 stocks. And so we went through the different characteristics and stuff to be aware of before you go and execute on any market, because the mechanics of a market do influence how you might want to take trades and how you might want to tweak your entry process depending on the market you're trading. And then we finished off talking about our scanning process, where we have a static list of macro products that we scan every single week. And then our stocks are rotated out. They're dynamic watch lists, and they rotate out depending on the macro fundamental bias at the time. And so usually what we do is look at the charts on a weekly basis on the weekly time frame to identify any interesting patterns in the market. And our focus is on things that are popping. We want crispness and clarity. That's extremely key. So that will filter out all of the weaker signals and the weaker moves and leave us with the absolute highest quality. So we emphasize quality over quantity always. And then we set alerts to do the heavy lifting during the week. This keeps our nose out of the charts. We can get email alerts or text alerts to tell us when something's actually breaking out, and then we can execute on it if needed. But we don't need to stare at the charts all week, and that's a huge time savings. So for Section 5 action steps, here are a few things I want you to do. Go out and define a universe of products that you want to trade. Okay, everyone has differences here, so you may not want to trade futures, or you're not able to trade futures, or maybe you only want to trade Forex, or maybe you want to trade everything. Define what you want to focus on. Then create a static watch list based on what you defined in your trading platform. And then on a weekly basis, go and review all of the charts in the universe and draw the patterns where appropriate. So if you see something that pops out at you, an ascending triangle, head and shoulders, etc., draw it on the chart and have the charting platform save that. And then record the successful breakouts versus the unsuccessful breakouts based on your weekly analysis. So you'll draw these patterns on the chart, and then eventually the market will play out, and some of them will chop and not do well, and others will run and pay out very, very well. So you don't even necessarily need to trade the patterns. You can just simply record them and see how you're doing from an identification standpoint. And it's a way to sort of paper trade your analysis. That way you'll know and have more confidence when you go and use real money if you're relatively new to using price action analysis. So that was it for Section 5, guys. I hope you liked it, and I'll see you in Section 6 for Advanced Trade Management.